I'm here with Gary Reynolds, Chief Investment Officer, to have a catch up since our last CIO Talk. It's quite a lot to go through, so Gary, forgive me if I'm a little punchy today. Interest rates and inflation, or stagflation as it's been going on, what's happening there? Do you think that the government's views on increasing taxes is going to have a greater impact and lead us towards recession?
Well, let me just say we're not at stagflation yet. I accept that it's questionable whether we will get there, and just for people looking in, stagflation is where you have high levels of inflation and low or no levels of economic growth. So you get the worst of both worlds, really. Rising prices, no rise in GDP, no rise in real incomes. It's a messy situation. But inflation is certainly building up a head of steam now. You know, it's over 7% in the UK, it's over 8% in the US. And these are levels which we've not seen for a long time. And there's possibilities it will get into double digits. And that's something we've not seen since the 70s and 80s. So, yes, it's quite a new phenomenon for a lot of people working in financial markets who've never seen a period of high inflation before.
Gary, the market dips and weak pound stroke strong dollar. What's happening there? What's that about? And have there been any buying opportunities?
I think that going into this wobble this year, if you hadn't got your allocations right, you got badly hurt. And we came into 2022 with some trepidation. People would have picked that up from the December seminars. And I've been banging on about the risks of holding long-dated gilts, and those risks came to fruition this year. So if you were holding long-dated gilts, you've lost around 18% of your capital value, and that's meant to be a safe asset. If you are holding a basket of high-tech stocks, if you look at the NASDAQ, you've lost well over 20%. Right about the best market in the world has been the FTSE 100, which, if you like, is an old world market. It's got things like lots of pharmaceuticals, financials, materials companies, and they've done relatively well. Financials do quite well in rising interest rates because the banks can make a bigger margin on the difference between what they borrow at to what they lend at, and materials obviously do well because prices go up. So FTSE's been quite a good place to be this year. We've had a reasonable amount of exposure there. So whilst people have generally lost money in equities and bond markets this year, relative to our peer group, we've done extraordinarily well. Cautious and balanced, didn't get caught out by the rapid drop in bond prices, and we had been reducing our exposure to the S&P 500 index because of its fairly high level of weighting towards the pricier high-tech stocks. So whilst I don't want to say it's been a good year, because our clients are losing a bit of money in our main funds, but if they'd have been in other competitor funds or in the markets directly, they would have lost a lot more. So we have, the cautious stance we took coming in has paid off handsomely.
Gary, I'd like to look at the funds now. In communicating across the company recently, you presented 4 charts which cover volatility. I wonder whether you could talk us through each one of those. Now, the first one, which will appear on the screen now, is the rolling 30-day volatility annualized. Can you tell us about that?
Yeah, so this is the measure of the risk you're carrying. It shows the risk that your funds have been exposed to historically, and what anyone can see from that chart is that our rolling 30-day, which picks up really the short-term market movements, has been pretty good compared to the main market. And anyone looking at will also see that growth is a bit more volatile and balance is a bit more volatile than cautious. And that's exactly what you'd expect to see, because Cautious is coping with, or is providing a facility for investors that don't want too much risk and don't want to be 100% invested in equities, whereas growth tends to be full on in markets. So what you can see from that chart is that our volatility has been pretty good relative to the market.
Thank you, Gary. Beta using 30-day volatility. What story does that tell us?
Well, beta is a measure of your exposure to the market. So if you like, a very simple way to explain beta is it's the volatility of your fund over the volatility of the market. If your fund is more volatile than the market, and here for market, read the MSCI World Index, the yellow lines on those charts. You won't see them on the beta chart because it is the denominator in that, so it's the one where everything is relative to. But if your volatility is lower, your beta is therefore below 1, and we have risk caps on the funds, so our betas can't exceed certain levels. But you will see again on that our funds have been doing their job. We've not had too much market exposure in the past 30 days. Are you going to look at the 260-day ones as well, Leo?
Yes.
They'll tell us.
Yes, because this paints at first glance a somewhat smoother line and things look consistent, but I think with some explanation there might be another story there.
Yeah. So if I just explain to any viewers, 260 days is sort of the recognised number of, generally the number of trading days in a period. So this is like a 1 year rolling, and again it does smooth out because you're taking your time period over a longer. If you like, it would be the same if you have a longer rolling average compared to a shorter one. But what you see again is similar. Our volatility is pretty consistent, generally below market. And if you then go on to the beta, which I think is the other chart you were talking about, yeah. Leo, what you can now see is how much market exposure we've got, with a beta of 1 being more than the MSCI World Index. And what those charts tell you is that we have been plotting a pretty careful course for the last year or so, and that's consistent with me continually saying that that it's less certain now than it was, ironically, in the summer of 2020, where there was loads and loads of value around in markets, and we just went out there with our buckets and scooped it up. It's much more difficult to find it now, so we're being much more cautious in the way in which we're positioning the portfolios.
Sure, and I see that will continue into the future. Gary, just to close, talking about future, I'm sure many people will be thinking about holidays this summer and exchanging their pounds into whatever currencies they might need. Do you have any advice on when that might be a good time to do that?
Yeah, well, I think there's been a lot of talk about the pound being very weak, but the truth is it's just the dollar's been very strong, because the dollar's been strong against the euro as well. So the pound is fractionally weaker than the euro this year. It's significantly weaker compared to the dollar, as is the euro. So the truth is it's the dollar going up rather than the pound coming down, which makes sense. Everybody sort of rushes for the dollar when things get a little bit uncertain. And with the Fed increasing interest rates and long-dated yields going up in the US, there's been a bit of a renaissance in demand for US assets. So what would I do if I was a holiday maker coming up? If you want to, well, first of all, if you've got the cash there and you can't afford to. You haven't got the scope to take the risk that the currency may go further against you, then get your currency bought now. But if you're asking whether you can sort of have a little punt and think, is there a better time? I would say you will probably get a better time to buy dollars over the next 2 to 3 months. But if you're going in Europe, I would probably buy my euros now. So there we are. I've done exactly what forecasters shouldn't do. I've given you some estimates and I've put a time frame on them. So, in August we can actually have this conversation again, and we can find out whether I was right with regard to the buying your pounds, euros, yen, or whatever you're getting for your holidays.
Look forward to that, and may either of us have a glowing tan. Gary, thanks again very much for your time. To our audience, thank you very much for watching. As always, if you have any questions, please do let us know, and we'll catch up with you again soon. Thank you very much.